In this video, I want to introduce a new indicator on TradingView that can effectively predict future price action. It gives the most accurate buy-sell signals ever. To add this amazing indicator to our chart, here we click on indicators and we search adaptive Kalman filter, this one, which is written by Zierman. Alright, this is the indicator, and as you can see, it's added here below the chart. This is actually a trend oscillator, and as you can see, we have a line that is moving above and below the center line, which is 0. This indicator uses advanced mathematical techniques to separate trend and oscillatory components from price movement. This indicator uses Kalman filter model that assumes that price is driven by two latent factors, a long-term trend and localized oscillations around the trend, which is actually smaller price fluctuations around that trend. The Kalman filter uses an adaptive predict update process to estimate both of the components, and the result is a clear view of the market trend and strength. This indicator offers three Kalman filter models that each of them is designed for different market conditions. If you go to the settings of the indicator, you can choose your desired models. Here for Kalman filter model, you can see that we have standard, we have volume adjusted, and we have Parkinson adjusted. The standard model balances responsiveness and smoothness, and it works well in general market conditions. In volume adjusted model, the noises are adjusted based on trading volume. When there is higher trading volume, the filter considers them with higher confidence, and when there is lower volume, it is treated as less informative and considered low activity period. And in Parkinson adjusted model, the noises are adjusted based on price volatility. It uses high-low price range to determine the sensitivity of the indicator, so this is a good choice for markets with higher volatility creating frequent gaps or sudden extreme high or low prices on the chart. In normal condition of the market, there is no much difference between the three, and as I said, the standard model works well in general market condition, but depending on the market condition or the asset that you're trading, you may need to change the model so the indicator better responds to the market condition and changes that are happening in the market. Before I teach you how you can interpret and effectively use this indicator for trading, I want to introduce a charting platform that is exactly similar to TradingView, but it allows you to add up to 64 indicators to your chart for free on TradingView platform. On the free version of TradingView, you can add only 2 indicators to your chart. So if you want to test a trading strategy with more than 2 indicators, you just need to go to FastBull.com, which is a trading platform, and then here in products, you can access their charting platform, which is exactly similar to TradingView, but everything here is free. All the tools and functions that you have on TradingView platform, you have also here on this platform, but you can explore unlimited historical candles. You can add up to 64 indicators at the same time to your chart. You can have charts of different assets on different tabs, and each tab with different indicators. You can save unlimited templates for your charts. You can add up to 1000 symbols to your watch list, and you can add up to 1000 alerts. Everything here is free, but this is not all with FastBull. They have full coverage of news and live analysis from institutions and analysts. They cover every market and assets that you need, and they have also other products like chats, Q&A with experts, screeners, economic calendar, and more. The links of their platforms are below the video in the description, and make sure you check them later. Alright, getting back to our indicator, as you can see, we have a line here that is overlaid on the price chart, and this is called adaptive Kalman filter, and you can interpret it exactly like a moving average line, with one difference that it changes color, green and red. As you can see, green when the market is uptrend and red when the market is downtrend. Sometimes it also becomes blue, which can be because of a pullback or a reversal may happen after that. Alright, here in the oscillator part, we have this line which is called Kalman trend oscillator, and you can see that it is oscillating above and below the center line, which is 0. When it is above 0 and positive, the market is in an uptrend, and when below 0 and negative, the market is in a downtrend. So like any other oscillator, the center line crossover can be considered as a trading signal because it can show beginning of a new trend. When the line crosses below the center line, it's a bearish signal, and when the line crosses above the center line, it's a bullish signal. In compared to other oscillators, because of the advanced mathematics behind this indicator, it is able to remove many of the noises around the center line, so you have more accuracy, but still we can have false signals like this bullish signal that we have here, and especially you can encounter them when we have a deeper pullback in the market market or the market is in a trading range. So when it comes to centerline crossovers, you can have perfect signals providing good movement of the price to make profit, but you can also encounter bad signals. So if you want to make a trading decision based on these centerline crossovers, you need more confirmation from other indicators or aspects of technical analysis that confirm a reversal is probably happening, so you can decrease your risk as much as possible. The best use case of this line would be trend identification and then taking buy-sell signals in the direction of the trend. Later, I will teach you a trend following strategy, so make sure you watch this video until the end. Alright, as you can see, this line also changes color, green when uptrend and red when downtrend, but there are also times that the line becomes blue. When the line becomes blue, it shows that the trend is weakening. For example, here, the line is above zero and green, showing uptrend, and from here, it became blue. This shows that the uptrend is weakening. Two situations can happen. It can be just a temporary weakness because of a pullback, or it can be beginning of a greater weakness and a reversal in the trend is happening. After being blue, if the line again turns to the color of the line before blue, for example here, again it turned to green as you can see, and this shows that the weakness was just probably a pullback, and now the pullback probably ended, so we can enter a long position in the direction of the trend. But if after blue it changes to the opposite color, for example here, after blue you can see that it turned to red, which shows that probably the weakness is more than a pullback and a reversal is happening in the market. Similarly, in downtrends, when the line is below zero and the color is red, showing a downtrend in the market, when the line becomes blue, it shows a probable pullback, and when again it turns to red, it shows that probably the pullback ended, providing us a trading opportunity to enter a short position. But you can see that here, after being blue, it turned to green, and this gives the signal that probably a reversal is happening in the market, and you can see how the market turned to an uptrend. You can effectively use these blue signals for entering a trade in the direction of the trend. It provides you the opportunity to enter a trade in the pullbacks and enjoy a low risk position. Entering a trade in the pullbacks in the same direction of the trend has lower risk in compared to entering a reversal trade which is against the current trend of the market. Alright, the indicator has also marked 70 and minus 70 for overbought and oversold conditions. When the oscillator reaches to or goes above 70, it shows overbought condition, and when it reaches to or goes below minus 70, it shows oversold condition. But as you know, overbought or oversold doesn't necessarily mean reversal. They just tell us that the movement is probably going to weaken, and after that we can just have a pullback. A reversal can also happen after an overbought or oversold condition, but the safest interpretation that you can have with overbought or oversold on this oscillator or any other oscillator is that the current trend is weakening. A stronger signal that you can have with this oscillator is having a divergence happening after overbought or oversold. For example, here you can see that the price made higher high, but the oscillator made lower high, and this is a bearish divergence telling us that the upside momentum is weakening and downside momentum is gaining strength. This is a leading signal that a reversal is probably going to happen, but it needs more confirmation. When the low of the divergence pattern is broken, in other words, a candlestick is closed below the low of the divergence pattern, the sell signal is confirmed and you can enter a short position. Please pay attention that here also there was a bearish divergence, but we didn't have any candle below the low of the pattern and the price advanced more, and here again another bearish divergence, and for this divergence the confirmation happened at this point when this candle was closed below the low of the divergence pattern. Similarly, when the price makes lower low and the oscillator makes higher low, this is a bullish divergence. It shows that the downside momentum is weakening and the upside momentum is gaining strength. The signal is confirmed when a candle is closed above the high of the pattern, which happened here at this point. So in practice, you could enter a long position at this point and you can see how the price turned to an uptrend. Please pay attention that here also before this confirmed reversal signal, we had another bullish divergence, but the price couldn't close above the high of the pattern and we had more decline of the price, creating another bullish divergence, but this time we got a confirmation and the price actually turned to an uptrend. This indicator, by the help of advanced mathematical calculations, it provides you a very smooth picture of trends and their strength. It creates very accurate signals on the trends or momentum changes within trends or momentum changes before reversals by the help of divergence signals. But please pay attention that this doesn't mean your profit is guaranteed by the help of this indicator. indicator. No indicator or strategy can provide you 100% guaranteed signals, and you need to manage your risk properly. There is a risk management strategy that is called 1% rule, and it's one of the best risk management strategies that you can use. I have a complete guide on this. The link is also placed in the description, and I highly recommend you to watch it, because without a proper risk management strategy, you cannot become a successful trader. Alright, that's it. Thank you for watching this video. If you have any questions, feel free to ask and leave a comment for me. I'll answer your questions as soon as possible. If you haven't subscribed to my channel, please subscribe and hit the bell so you get the notifications of my new videos. See you guys in next video, and good luck with your trading.